Respark stuff coming up. So for up-to-date members, you basically get to restart on the 8-week plan. We'll probably do it in 4 weeks or so, this next upcoming round. And it'll basically be kind of like these live calls, but we'll go through every single person's weekly updates and everything that they're doing throughout the week and everything that they need to do to take action the next week. So people who are older in the group can join on, people who are newer in the group can also join on, and we can all just kind of hear every single person's actions that they're taking throughout the week. And it's kind of just a very action-oriented respark, reboot.
Yeah. Perfect. Well, let's do that real quick. Then we can just kind of roll right into Richard's deal. Richard, I'd like to give you the dance floor for a second. If you can give us just a quick overview again for those that are new, your story, where you're at, how you came across the deal, and then we can get into maybe some of the weeds on what you're dealing with right now, man. That'd be great.
Yeah, so I'm in the Northeast Georgia mountains. That's where I live, about an hour and a half northeast of Atlanta, up near Helen. Forget who it was that said they're from Atlanta. Who was that? Was that you, Brent? No,
That's Craig.
somebody.
That's
Craig.
great.
But I used to live in Atlanta and I know that region very well. It's
Yeah, yeah,
beautiful.
yeah. So,
Yeah, I
but
like
right
Helen,
across,
Georgia.
yeah. So a broker of mine here in Atlanta found this deal in Birmingham, which is right down the street from a couple of deals that or buildings that Nolan already has. So, long story short, where we are in the process is we're in the due diligence period. Um, and I'm trying to, if you're on the call last week, we went over some of the due diligence items that I was working on. For example, getting the all the agreement. I have a limited partner that's doing this with me. She's bringing the down payment and a few other costs like some closing costs and attorney's fees and stuff like that. We're going to roll into her money. She needs to deploy about a $500,000 by the end of the year if she can. And so we got that agreement done. Got my LLC set up. Working with the bank, and that's what we're going to go over in just a second. He's offered a couple of different options for us. Whoops. Also getting the insurance. I've got PNC quotes coming in. I've got one already. I'm waiting on another. Um, I need to order the inspection. So I don't know if you saw that, Nolan. If you have any inspectors in Birmingham, I'd love to hear who you use over there. I don't know anybody over there. It'd be nice to find somebody. The only thing that's going to keep us from not closing by the end of the year, I think, is the appraisal. That's going to take a little while with the holidays. Ryan at the bank said it's probably unlikely, but that's okay. It's not going to be a deal killer. So what I want to about now is the bank. We underwrote this at a 75% loan to value. So my partner Barbara is bringing the 25% down payment plus a few extra items, and so that's probably the option we're going to go with. And Zane and I talked earlier today. He did a quick synopsis. The numbers might end up working out a little better than what we have in our pro forma.
Nice.
So you can see there's the email. The first option, 75% value. That's a $1.5 million deal. So 1.125 would be the 75%. I think Zane's going to pull up the pro forma. There it is.
Yeah, Nolan, I have Richard's fully
Okay. Well, if you
outlined pro
want to
forma.
share, then go ahead. Yeah, go
Yeah,
ahead.
Yeah, go ahead.
I'll do that if you want.
Yeah, that'd be great, Zane.
So you can see where the numbers are. That sounds great.
Yeah, I want to see if they match up. And I think this will help the rest of you guys as you're working on your first deal. This is my first deal. You
Do
know,
you have
I
do you have like photos of the building by chance too? Like I mean I've walked the building with you, Richard. For those that we walked the site together. But is there any photos so people can put like a little name with a family?
I don't know if it's in there. I don't think it's in there. We could probably pull it up on Crexy or something, but LoopNet.
Is it north of 4th Avenue north or 4th Street?
Yeah, 204th Street West.
Oh,
Birmingham.
Yep.
There it is.
Just for you guys that don't know anything about this property, it was built in 71, so it's not a brand new building, but there's been some HVAC work done, some plumbing, electrical work. They put a new roof on it a couple years ago.
Yeah.
You'll see that white, the dock, the ramp is brand new or a couple of years ago. I think Nolan actually looked at this property a few years ago and they had not done some of this work yet, so it didn't look as good. But you can see out front of the property there's some potential laydown yard that we can talk about in the future. Maybe fence that in and rent that out for a couple grand a month or something. Who knows? It backs up to a railroad, if you can see behind there. And I've heard through the seller's broker that he wants to put in what do they call that thing?
A spur.
A spur, so that they can have the cars come in and they can load and unload right off the back of the dock there. And if they want to do that, we'll let them do that for sure. That'll just, I think, add value to the property. So
Not
it
only to the
meets up.
property too, but it also wedges your tenant in there longer. Like,
Yeah,
how often are you able to back up next to a railroad track and have a spur? It just your tenant's never going to want to leave because it's hard to find those sites.
yeah. And the seller actually locked in this tenant right before we went under agreement with them under contract. They signed up starting 11/1, so just a little over a month ago for a 5-year triple net lease. So again, it matches all of our buy boxes. The size. It's a 28,000 square foot building. It's got all the doors. It's got 50-foot ceilings. It's right off, within a mile or so from I-20. And so it hits all the metrics, which is nice.
A
You
And
get all
couple,
that land.
go ahead, Joey.
You get all that land in front of it too, up to the highway.
yeah, yeah,
And that's what
that's
I was going
right.
to mention is that's a huge other piece, and you really can't see it from this photo, but I mean you could fence that off. I did that on another site for those that were at the live, and we drove around, looked at those sites. If y'all remember the big building in Tarrant, I fenced off a yard and graveled it and graded it. It cost me I think $9,000 to gravel and grade a site, and I'm renting that out for $2,500 to some trucking companies. Like this is even you don't even have to. I mean, this would be simple to do for Richard and Barbara to do this. I mean, you're talking about easily adding another 20 grand a year to your net operating income, and then on top of that, again, you really can't see, but directly east or where those cars are on the left hand side, um, there's another building that's a little dilapidated. The other way. Well, you really can't tell them,
Yeah.
but it's just another opportunity just to number one, just create a little more of a monopoly on this space, improve the area, and rent it out to again trucking companies or some business that's looking to be close to the interstate. So and Richard didn't even mention one of the cool parts about this building is the city of Birmingham just got a grant for like $55 million from the United States. It's almost like an opportunity fund, but they're moving they're moving some of getting rid of some of these projects in this zip code, moving them somewhere else, and they're going to redevelop this area. So I think it's early. We're catching the wave, but it's early. But who knows what the value of this site could be in 6 years, 7 years. When you're owning it, and you're cash flowing it. I mean, the whole area could be totally different and developed at that point. So it would be pretty cool. It's a
One of the
good deal.
brokers, yeah, one of the brokers I'm working with on the PNC side, the insurance, she said she goes, you got a really good deal. She said that thing's going to appraise at 2 million plus easy. So we'll
Even
see
better.
if she's right. I don't know if she's right. I hope she's right. But and then on top of that, the improvement around the area hopefully will just drive up values. We'll see
That's
over
right.
time.
That's right.
So, Richard or Nolan, so regarding the extra land, because I think that land could create a lot of value. Have you guys determined by looking at the lease that the current tenant doesn't have access to that land?
That's a good question. I don't know the answer to that. That's a great question. That's probably something I should look at and see. I don't think there's any language. I didn't see any language that I can recall that stipulated one way or the other on that. But that's
Yeah, I think that could add value as you've indicated. The other thing is like the roof looks awesome, that ramp looks awesome. How's the condition of the parking lot?
it's okay. It's not horrible. It's
Yeah, I
not
wouldn't
great.
say that it's brand new. It's not
No.
recently paved or anything like that. I mean, if you wanted to go and tar it and stripe it, I mean, you could do that. But other than that, I would say
It's not
it
like
looks like
alligatoring or anything like that.
it didn't look bad enough to where I was like, oh my God, this needs to be improved. It was like, oh, this is another just a parking lot that's
Functional.
has a couple of years on it. Yeah, that's right.
Yeah.
Okay.
Yeah, that's something that'll have to be done. You're right in the future. By the way, while you just made me think of something. Thanks for that question. Great question. Remember we talked about the tenant estoppel last time, Nolan, and thanks for sending that form over.
Yeah.
The lease was signed between the seller and the tenant. Do I need to get a new lease between us and the tenant, or is that estoppel take care of that?
No, no, you don't need to get a new lease. They'll just
Okay.
it'll just transfer over to the new purchaser. That's it.
Okay.
Nothing more, nothing less.
All right. Just wondered about that. So, Zane, you want to run through the numbers? We can look at the pro forma to see what we thought the numbers were going to look like. And I know the interest rate came in right at 7%, which is what we put in there.
Yeah. So
6.99.
Oh, sorry, yeah. So we did expect about 7%. Ryan Blackenberg quoted 6.99. and he actually offered a 30-year amortization
Yep.
on that one, which is interesting. So we'll look at his email real quick. So at 75% LTV, 1.125 million, 30-year amortization, 5-year fixed, 6.99, monthly payment around 7,400. So if we type that in the pro forma, originally it was a 1.4, oops, what just happened? Originally it was a 147 DSCR on a 20-year amortization at 75% LTV. And if we move it to 30, it turns into a 1.7, which is
Nice.
interesting. And we've already got the money raised for the 25% down payment. So it's like we got options, of course. And then the other option though, 80% LTV, 20-year amortization. So what do you think? I mean, I guess we can plug in the numbers.
Hey,
Eighty
before
Well,
you do
here's the
that,
question.
Zane, real
Everyone
quick,
needs to ask the question, what's the most important to each individual? As all of y'all are like reading this, and go back to the other emails, Zane, if you don't mind.
Mhm.
Just looking at the email here, and you can see the differences here. For all of us that are looking at this, there's pros and cons to each offer, right? So do we want to, if we want to walk through it, we can real quickly. Obviously, in the first option, 75%, that just means you're putting more money down, right? You're having to bring 25% of the purchase price, which again, if you guys, if Barbara in this case, or your partner, whoever it would be, is already thinking in their head they have to bring 25%, well, then you're good to go with that, right? That's a good offer from them. 30-year amortization. I'm not gonna lie to you guys. That's the first time I've seen 30 years on a commercial property. Like Ryan and those guys are cowboys because I can usually get 25 with Millennial. 30 is the first time I've seen that. So that's awesome for all of us. Just moving forward, stretches our cost out. Now, you look at it and think obviously the interest rate is the same for both. The difference really, as you guys can tell, is at 80% loan to value, you're just going to have to put less, someone's just putting less money down. So in your case, Richard, and for everybody, if you've already negotiated with your limited partner, or if the seller's leaving money in the deal at 25%, well, then there's no sense in taking the second offer. But if you, as the individual, are bringing the down payment, it might be something to consider. But the difference, of course, there is you're looking at, $1,800 difference in monthly debt service, right?
yeah.
So a 30-year AM and a 20-year AM is a lot different, as you guys can obviously tell. Now, the difference is too, I like to stretch amortization out as much as I can. Interest is obviously deductible. And if you're playing the cash flow game, it allows you to be in deals for less money. So, what's y'all's opinion? I'm curious to hear if you guys were underwriting this and you were offered this from a bank, what initial questions would you have? And then how would you underwrite this when you're going through your pro forma?
I'll jump in first.
Sure.
I would look at it both ways, but to your point, if you've already got the equity, your cash on cash returns are going to be a lot better with a 30-year AM. But I'd run the model both ways and look at the returns. But I suspect number one's probably going to make more sense for Richard.
Mhm.
I
In
agree.
that circumstance.
I also was wondering too, Nolan, what you thought, because it's kind of like an illusion of
Testing
choice thing.
everybody. I want to test everybody if we're remembering. I didn't mean to cut you off, Zane, but I would like to ask everybody what is the metric and what's the hill that we're dying on? I would say I'm more speaking for myself here, but like what is the metric that's the most important piece at the end of the day? What is the number one metric that is number one?
I won't answer this one.
Zane, you know this one. Come on, guys. What is the
Cash on cash.
cash on cash return? Cash on cash. So we can go back and forth. We can look at the numbers and squeeze one way or another. My recommendation would be is when that banker shoots you that offer like that. Now again, Richard's situation is unique because he's got a partner, but I would run both scenarios and figure out what is going to squeeze the most juice. Which one squeezes the most juice regarding my cash? How can I get the highest return on my cash? And then from that point, again, the debt ratio is one thing, the cap rate's another thing. There's some metrics, but at the end of the day, how can I squeeze the most juice out of whatever money I inject into a deal? And that's also for Richard too, because for his partner, if he can be a good steward of her money or his money, whoever it would be, most likely than not, she's going to want to call or he's going to want to call and say, "Hey, Richard, like this has been great. How do we do the next deal? Like, what's the next one look like?" So that's what I would recommend. Like, There's not one offer that's better than another. It just depends upon what, number one, you're trying to accomplish. And if you are the way that I am, thinking about cash on cash return, run the numbers, and whatever one is the winner, that's the choice that you make. Thought on that, Zane? I didn't mean to interrupt you, but go ahead.
Oh no, you're good. I was actually, I love that, by the way. I think that was a great response. But I was even thinking there's two options here. Is there anything else that we can do? You know, like it's kind of giving us the illusion of choice, I feel like, of having to choose one or the other. Do you think there's anything else that we could squeeze out of it or like negotiate before we get down the road? Or do you think it's kind of like set in stone now?
I think everything's negotiable. Craig, what's your opinion?
I would try to squeeze the interest rate, right? I'm always going to
I
try
was
to
thinking,
squeeze that interest rate. So
yeah,
going 75% LTV, the 80%, you've got the same interest rate. Even though it's a different amortization schedule, I would definitely try to use option one, try to squeeze the interest rate
All right,
as much as you
I have a
can.
question.
Maybe
And
even go IO. Like, I mean, I might be speaking, but in my world, we usually get some interest only periods. I don't know if that's common in the space we're discussing today, but we're usually able to get some interest only years.
yeah, you could definitely get interest only. I would be curious, Zane, go over that pro forma real quick if you don't mind. Put up 30-year amortization, and then let's go over to the amortization, the AM table on the tab. And let's just look and see how much interest you're going to pay over 5 years if you want to scroll down to month 60. Okay, so that's total interest, 383 grand. All right, let's go back to the overview and punch in 20 years and just see what the difference would be. Or I'm sorry, assumptions page, yeah. 20. Let's just see what the total interest, what we would pay. So 368, right? So the difference is what, 15 grand ballpark? 383 or 368?
yeah, not a lot.
So this is not disagreeing with you, Craig. I would just challenge the thought that the interest rate, in my opinion, is the least important metric or in the offer, because really at the end of the day, it's the volume of interest. The volume of interest is going to the bank, period, dot. So my question would be is how much less money can I inject into a deal? And here's the thing, Craig, you're not wrong. They got wiggle room. They got to pay their bank fees. The banker's got to earn his commission, whatever. I look at it and think, hey, the interest rate is the interest rate. And not to mention too, Craig, you're right. I would even challenge going back to that email with Ryan. Ryan has the ability, you can buy that interest rate down, right? So maybe what you do is say, hey, how about this? Let's go with option one for just as we're underwriting this together. Let's say we're going to go with option one, but Ryan, instead, let's keep the 30-year AM. Let's keep the 5-year fix. But I would like to instead buy the interest rate down 200 basis points. So here's what you do. And let's say Ryan throws it back and says, hey, I'd like to, it's going to cost you 30 grand, right? To buy the interest rate down 200 basis points for 5 years. How does that change the monthly payment, Zane? So let's do this. So keep it, yeah. So go to the assumptions page, please. Yeah. So instead, the best way to underwrite this, I would say, is go to the offer price, Zane. And if it was before at $1.125 million, just change the loan to value to 100%. That way we can see what the total cost of debt would be.
Okay.
So that'd be 1.125 million, right?
Yeah, I believe that was right.
Okay, perfect. So just seeing what our cost of debt would be, same payment, whatever.
Oh,
What
do you
then
want to
I
go
would do, I'm sorry?
Sorry, you're saying you want to go see the cash flow?
I just want to see what the debt service would be, right? Because now because Ryan will offer that to you. If you make that offer back to him, he'll be like, oh, that's not a bad deal. Sure, especially if they're going to hold this mortgage for 5 more years. They're able to lend you more money. So the cost, they'll wrap that into the mortgage. So if the cost before was 1.125 million at 7%, and let's say it's 1.15. I mean, call it 1.15 million, right? Yeah, there you go, 5 million. There we go. And then drop the interest rate down to 5. There you go. Let's look at that debt service. What's that principal and interest payment now? If we go to our AM table, bam. And you still get the same 5 years. because what they're going to do, they're going to do a swap, or they might get cute. They might buy, they'll figure it out on their own back end, but they'll make that offer to you because they're lending you more money. And it also makes Ryan, the loan officer, more money because he's lending more money. It's like, it's a commission game. So that might be an offer that you can have. And he might say, well, if we're going to do that, we might only need to go 25 years. Well, you can shuffle the deck. We can figure out what the best terms are. But I would go back, if I'm you, Richard, is I'd say, hey, Ryan, awesome. We really like option number 1 or option number 2. We like to make a counter offer and say, we really like all these same terms, but we would like to buy the interest rate down by 200 basis points. What are you guys offering as the buy down rate? Something like that, right? And then put the ball in his court, let him make an offer to you. But at that point, you're talking about an interest rate like what Craig mentioned just a second ago. That interest rate does matter for cash flow. And look at the massive difference it is just from, if you can get 30-year AM, you can buy the interest rate down and you're borrowing more money and it costs you less per month. So you're able to increase your cash flow on the property without changing anything, without changing any of your injected cash, just by adjusting the terms.
And I'm sure Barbara would love that because she's getting most of the cash in the early years anyway.
Did everybody? I'll walk through that again. Did somebody not see what I was talking about right there? I want to make sure I was clear on how we were able to get to that. Does someone have a thought or question? I'm happy to rerun through it. Did everyone see how I walked through that, or what that vocabulary sound like when I made that offer? I'm not trying to call anybody out. I'm more of just like wanting to make sure that I'm being very clear with how I'm able to take what Zane's showing, these 2 offers from a bank where he says, hey, we're good with this loan. Perfect. They're already approved. The loan is approved. By the way, Ryan Blackenberg, who's with Millennial, and he doesn't care if I shared this, he's on the loan committee. So it's literally him, another loan officer, and the president of the bank. There's 3 of them. So if there's any approval that's needed, he's 1/3 of it, right? So if he likes you as the borrower, he likes the deal, he likes the location, he likes the tenant and the lease, dude, you're already 1/3 of the way there. And he's been working there for like 6 years now. Like he's going to tell you no before he even takes it to the loan committee. So I say all this, when you've got basically a vocal approval, now it all is just dialing in the terms. And like I said, I've done this deal, and it's the same. And I say all this because I did this exact deal with Ryan on East Cliff. For those that were at the live event, my tenant Mike Parlier, where we had lunch and we had the beers at his office, like that building. I bought that building. I bought out my partners on that building. I borrowed more money. I bought that interest rate down on a new loan, and my mortgage payment went up by like $104. But I borrowed like $200,000 because I bought the interest rate down compared to where it was when I initially borrowed the money. So I say all that, those options are there, especially if he's offering 30-year amortization. He's a cowboy. He can make these types of offers. So did everyone see how we got to that, and how like the vocabulary, how you can change those numbers and the cash flow on things?
Hey, I got one quick question, Nolan, just so I can make sure I'm clear and I understand.
Yeah.
So when you're buying down the rate, let's say hypothetically it was $30,000 to get the 2% buy down. Are you just basically rolling that back into the loan, the 30 grand?
Yes.
Okay.
So I'm using, and I was actually being even conservative because I bought the interest rate down. It was $10,000 per 100 basis points. That was the cost. And I think he would only able to go up to 20 grand or 200 basis points. So if I was to say 30 grand for 200 basis points, that'd still be more expensive. So what you would do, Andrew, is if everyone's looking at that first number where you would borrow $1.125 million on a 30-year amortization schedule, he's offering you 7% interest rate. Instead of borrowing 1.125, you borrow 1.5, right? Or 1.15, sorry, went to public school. So you would borrow $1.15 million on the same amortization, the same 5-year fix, but your interest rate then would be 5, not 7. And so that knocks down your monthly payment by, what was it, Zane? Like $1,500, something like that, whatever the number was.
I don't remember.
Well, it's significant. Yeah. It's not insignificant. even if you borrowed more money because that interest rate is lower, like Craig mentioned before, it just increases your cash flow straight up and down.
And so
Without changing your capital injection.
I was going to ask a quick question. How important is it to kind of zoom in on the first 5 years? Because I mean, knowing that this is a 5-year fixed rate, I'm assuming that if it's going adjustable after that, you're going to want to either refinance, or you're trying to flip it at 5 years. So kind of really knowing exactly kind of the financial implications over that first 5 is probably the critical point to zoom in on before you kind of make that decision. Or
yes, every 95% of loans are always going to have anywhere from a 5 or a 7-year term. And that's really protecting the bank. It's not really protecting you. It's really protecting them. They're the one lending you the money. It's basically saying, hey, if interest rates are crazy high or crazy low, it just allows us to readjust our cost, whatever that number is. So, and not to mention too, after 5 years, you're most likely going to want to refinance. I mean, how much principal pay down have you paid down? You're going to probably want to refinance it, pull more equity out. You're going to have more appreciation. I mean, even on our calculator, you can look at the 5-year seller balloon payoff. I mean, in 5 years from now, that building's going to be worth at least 15% more than what you bought it for because of the rent increases, right? The 3% rental bumps. So, I mean, at least you can pull out another $250,000 or $300,000 of equity. Or if you wanted to sell it to somebody at a rate of return after renewing the lease. So you've got options at that point, but the bank is I only really look at deals off of a 60-month window. That's not to say that's the only way to do it, but I really look at things from a 60-month window. When you get a tenant that's on that other side of the 2.5 years left of their lease, that's when I begin to start to focus on renegotiating that lease. Because then once you renegotiate that lease with another 5 years or even longer, that allows you to go back to the bank with firepower to, again, negotiate better terms on your existing loan. Does that make sense?
Hey, guys, thank you very much. I'm sorry I have to go. This has been extremely helpful. Thank you,
Awesome.
Nolan. Thank you, Zane. Thanks,
Yeah,
team.
we're going to keep talking about you, Richard, if that's okay.
Please do.
Richard, good luck on your deal.
That's right.
Thanks, guys.
Great.
Appreciate you. Thanks for your support. We'll talk again soon.
See you, Richard.
All right, bye-bye.
Nolan, so do you always try to buy down your rate, or when would you not want to try to buy down your rate?
Man, I'm buying down the rate. There's an axis or whatever they call that, like a maybe in high school math, where there's a risk versus reward where the juice isn't worth the squeeze. Where after a certain amount of time, the buy down, you won the deal. The bank essentially, I'll write an article or something or make a video about this because I'm not even 1000% dialed on it. My wife was a loan officer. She's like, people would buy down the rates all the time, but the bank essentially is betting on your emotion, meaning that they're expecting you to either refinance because mortgage rates go lower, or they're expecting you to sell after a certain amount of time. Usually on a 5-year term, it's around 30 months. So of the 60-month, it's like 30 to 35 months where if you hold that building or that property long enough, you end up winning the bet. The bank is betting that you are going to sell or refinance within that amount of time, and they were able to get you for some more fees and earn more interest because they lent you more money. But if you hold it long enough, the lower interest rates actually ends up beating. It's like an option basically. It's like a put option. Like the longer you hold it, either you win or the seller wins, or the bank would win, that kind of thing. So I always try and buy down the rate because I'm always thinking quote unquote long range, but every now and then, like I'm always just making the offer back. Like for again, the guys that were at the live event, it's like everything is negotiable, like everything. So anytime they're the ones that make the first move on making the offer, I just try and like not knock them down, but just go back and say, hey, well, this is where I'm at. Like, can we do it or not? Like, this is where I'm at. This is what my other guys offer me. What can you offer? And it's just trying to move and shake the tree up as much as we can to get the best terms.
Nolan, are you shopping around, and are you going back and forth with Ryan? Sounds like Ryan's your primary banker, but are you using other rates and getting him to potentially push it down?
Ryan is just one. I run with like 3 main guys. I got a guy at West Alabama Bank. His name is Mason Morris. I have at Renaissance Bank, Patrick Levette, and then Ryan Blackenberg at Millennial Bank. And all 3 of these guys are on our CRE collective contact list. So you guys can, they got their cell and their emails. You guys can reach out to them directly if you'd like. I run Mason, who at West Alabama. They're a little bit of a larger bank than Millennial. Millennial Bank only has like 250 million of assets. So they're very limited as to how much they can actually lend you as a borrower because of federal regulation. Obviously, Renaissance Bank has like 20 million or 20 billion of assets. West Alabama has like 6 billion. So they have a much larger line of credit essentially that they can lend you money. The smaller the bank, the more negotiation you can get with terms. That's why with Millennial, they're a smaller bank, but they can do a lot of things, but they can only just lend you so much. Like Craig, if you called these guys yesterday, they probably can only lend you like $4 million, which is a great deal still, like for its first couple of buildings. But you start doing more buildings, more deals, you're gonna have to call somebody else. Like you're gonna be capped out with them pretty quick. So the larger the bank, essentially the less negotiation. The smaller the bank, you only got so much capacity, but the terms are incredibly negotiable. If that answers your question. So that's the way that I would, when I'm underwriting a deal like that, I'm just looking at, the initial terms. Again, I would recommend everybody when you're meeting with brokers as you're getting the ball rolling, always ask for recommendations of other lenders that a broker has closed a deal with in the past. So like I said, Brent and I were speaking on the phone earlier. He's like walked some sites. He's doing his thing already. I would recommend when they say, hey, okay, this is a cool, I'll say, all right, well, what lender are you running with? What deal closed last month that you ran with? Like what local bank closed that loan on the last deal that you closed? Can you give me an introduction? And then bam, I always say this to everybody is like, go sit down with that banker the same way that you did with the broker to introduce yourself, and then send him or her your personal information, your financial statements or your personal financial statement and your couple of years of tax returns. That way they can underwrite you as the borrower, whether you are strong individually or you're not. It allows them to get to know you as an individual first financially. That way, in a month from now or in a couple of weeks, when you do present them an offer and we can go over a proposal for financing, what will happen is they're going to respond and be like, okay, we already know this guy. I've already met with him. I like him. We're going to give you a soft yes before an immediate hard no. It just allows you to be more agile when opportunities do come up. That's what I've discovered, at least. Thoughts on that, anyone? So, yeah, the way that I look at this too is, and when you're underwriting a deal like this, especially with Richard and the partner again, and this is awesome because the other partner that's on this deal, her name is Barbara. She's in our group too, and I'm sure she wouldn't mind me sharing. But like they're partnering up. She's bringing the down payment. That's the same offer that I've made to a lot of partners. Where if I always like to have the seller leave money in the deal simply because that just leaves me more ownership and equity to take the bonus depreciation. But in this case, Richard's chasing some cash flow. So is Barbara. She needs to deploy capital. What I always like to offer people, my very simple, again, elementary offer is 50-50 ownership. And then my partner who brings the down payment, in this case, it'd be Barbara bringing the down payment of $500,000 or less or more, that she gets 100% of the cash flow until her principal is repaid. I think they negotiated maybe a different ownership split and things like that. But again, it's also at the end of the day too, if someone doesn't, 50% of something is better than 100% of nothing. So I like throwing out offers like that to people. And while you guys are out there looking at sites, finding other individuals who would like to partner with you and just kind of write them down on your list. Or who was I talking to last week, Zane? I was talking to somebody about this. Maybe Caleb, Caleb Clibb, who's in our group as well. What I'm going to do is I'm going to start, and this will be for everybody. As I'm just, growing my business the same way you guys are growing your businesses. Anybody that you run it with that says, hey, you got a next deal or a next project, I'd be interested to hear more. Like I'm not giving you a yes, but I have curiosity. We'll just start a living document of just, hey, a name and a cell phone and an email. and maybe what their number of interest, like, hey, I'd like to maybe do $50,000. I like to do $500,000 or whatever. It doesn't bind them to anything, but it puts them as kind of our network of champions. So when an opportunity does come up, all of us as investors, we can go to this champion list, copy and paste, send out a templated email, and it gets all those people on that list first dibs and first look at our deal, which allows us to essentially raise capital a whole lot easier. It just gets us, and like I was joking, gets us on second base. So we're in scoring position versus battling at the plate trying to get on base. So that's another thing that Zane and I are working on as we're going into the new year, just making shit easier for everybody to close deals straight up and down. So that's what we're working on.
Speaking about that, we can get into kind of the new updates that I just put out
Yeah, that'd be great.
the other day, and then that will lead us into the next thing we'll talk about, which is John's deal that he's got going on. So some new stuff, just the comprehensive LOI template. John actually used that exact template pretty much to get this deal that he's about to get under contract. Um, had the whole seller financing in there and everything, which is awesome, and two offers too. So that's one thing. We'll get into that. The pro forma just has a little update. Phase one environmental check, tenant estoppel. We talked about that last week on the call. If anybody has questions about what that is, I mean, you can look it up, or you maybe watch last week's recording. And then Siri collective contacts. We kind of just talked about that a second ago. All of those people that you need to know, that you can get in contact with. A lot of these people are super open-minded, just like Nolan is. You can call them up, you can text them, whatever. So many different resources on there. And we'll get into John's deal. So basically, the seller has now, he's at the point where the seller has now drawn up the PSA and sent it back to John to basically sign off on. And he is going to get his attorney to review it before signing off. But there's a few things that we want to kind of check off first. But he used in here, let me see if I can find it. Oh, like this is the comprehensive LOI template right here. I actually took the template that he and I worked on for like hours and hours and just took out all of the variables and put in for you guys to use as your own templates. So you got the offer A, offer B. A lot of times sellers won't even be aware of the idea of seller financing in the first place. So, and then sometimes, there might be discussions through, the brokers and everything, like, hey, they probably won't be interested in seller financing, whatever. But this is just an opportunity to put in your LOI that's going to be right in front of the seller's eyes, both those offers, and one being the seller financing offer too. And the idea is you give them one offer that's really high. It's got some financing contingencies, but it's in their best interest anyways, most of the time. And we can kind of communicate that here. And you give them the second offer that's a much lower cash price, and that acts as an anchor. We don't actually really expect them to take it, but if they do take it, then great. It's even better, really. And so goes through all this different language and stuff. John used this, and now he's about to get this one under contract. So we're going to go and look through the contract with John and everything here soon. And Nolan, I had a question for you as well on this deal, if you have a sec. So basically,
Yeah.
he got the seller to finance the down payment, 25%. He got a term sheet from the bank already for 75%. So this is like textbook, right down the middle of the fairway type of deal. This is the pro forma, 11.2% cap rate. This is going to be a sale leaseback. The seller is signing a new 5-year lease at $389 a foot. And he's buying this at 37 or $34 per square foot, which is extremely low pretty much anywhere in the country. So that's great and everything. And Nolan, I was telling him that maybe a good kind of incentive or whatever to have to kind of as a guardrail to make sure that the seller continues staying in the property, paying their rent and everything, is that if they exit the lease or if they break the lease before the 5-year balloon period and the 5-year lease, then they just forfeit their balloon payment. Do you think that's a good idea to put in the PSA, or do you think it doesn't really matter?
Yeah, I like that. And I also think too, when you are negotiating the deal, that if they decide to bail early or whatever, they're also personally guaranteeing the lease. Like the owner of that property or that business, let's say again, it's 123 Mechanics, and he says, "Oh, this is great," I would first get my eyes on his profit and loss statement, his balance sheet. I like to see what his percentage of capital is being paid towards rent, especially if he's an owner user. He probably has a lease, but as any other owner user, I would say 9 out of 10 of them, they're not necessarily like paying themselves a rent rate. Maybe, maybe they are, maybe they're not. If they are, it's a mortgage payment, right? So figuring out what that cost is of using the space, whether it's a mortgage or whether it's rent, what is that cost of usage compared to their gross income? And my banker would tell me it's almost like a debt to income ratio. If that number, let's say that they're bringing in $500,000 and their rent is $250,000, well, then they're at a 50%, you know, usage to gross income number, or whatever ratio you like to name that. That's pretty high. And he would say anything below 40%, similar to a debt to income ratio. He's like, if you see something that's like a 25% to 35%, you're looking, that's a middle of the fairway. So just consider that if someone's doing a lease back, that the cost of the rent is not extremely high compared to what they're already currently paying, right? That's one thing. And then when you do go and close, I would recommend the lease having a personal guarantee from the owner. That way, that owner is on the hook legally. He's personally guaranteed. He's putting his mortgage up as his house as collateral, like putting his family on the hook. People show up to work when their family's involved, right? So personally guaranteeing something, and then, like you said, Zane, protecting you if they decide to get abducted by aliens and bail out to Cabo, then they're forfeiting that balloon payment after that 5-year window or whatever the balloon was negotiated.
Yeah.
Did everyone follow that? That's what I would recommend. And it just gives you three ways of collecting and 3 ways of you getting out without, basically it protects you 3 different ways, and all the seller has to do is just pay the rent. Like the seller is really it doesn't put in the seller in any weird position unless he doesn't pay, right? So it truly incentivizes the seller and the deal to go smoothly. So it protects you and the seller. It's a win-win on both sides.
That's good.
Plus, if he's leaving money in the deal, he's earning interest, right? It's a win-win deal.
Mhm.
He's saving money in capital gains tax.
Yeah, that's great.
Yeah. So just my opinion on that. Well, let's do this too, Zane. If you're not opposed to it, look,
Yeah.
You want to get in real quick just to the just into the Respark and what we're going to be doing going into the new year.
Yeah, so we're
I'll
gonna
let you
set
talk about that for a second, and then we can kind of wrap up. But
yeah, we're gonna just set some dates for when we can expect to start on that. It should be probably like early to mid-January. And yeah, probably 4 weeks worth of it.
Yeah.
And maybe what we could do too is like instead of like we do 4 calls, but spread them out every other week. That way people can go through the 8-week plan on their own time, have 2 weeks to complete the modules and everything. And then we could talk about it, so that could be an option. And if you're not up to date on your subscription, of course, let us know about that and we can work with you on that. And then we will, get to work probably, yeah, like mid-January or so. And that helped a lot last year.
yeah, that's a big key. So this Respark group, if that's what you want to call it, it's for all those that you start something, you're getting excited about it, you get emotional into it, the same way I'm about pretty much everything I do, I guess, and Zane, is you get into it and then a month and a half go by, we're not billionaires yet, and you're like, this real estate thing doesn't work. This is fake news or whatever. This is basically giving us just another way to be coming together as a team, huddling back up, figuring out our game plan, and then going into 2026 to knock the ball out of the park, right? Just to give us a really clear roadmap on what actions that we need to take and choices we need to do in order to get where we want to go. So it's kind of reverse engineering. Zane, if you don't mind, real quick, can you pull up our acquisition package, please?
Yeah.
So Zane and I just we came up with this, and I think it's a really cool little addition that everybody can have. But if you want to go over to the financial freedom calculator, I think this is really good for everybody just as you're filling it out for yourself, right? I mean, everybody has different monthly expenses in their own lives. You can fill all this stuff out yourself, and all in the estimates, you can figure out, okay, this is what I, again, estimate to live my life. The reality is what it actually costs you to live if you guys are doing your QuickBook accounting or whatever. And then obviously that will spit out an annual. And then what you'll see on the right is the property value to own. This is basically how much real estate do you need to own in order to have your passive income exceed your monthly expenses. Like this is just kind of the quick calculator for you to look at. So you don't have to get crazy detailed into it. We just made this. This seems to be the highest level way to say, okay, now I've got a goal. I've got an idea in mind of if I live my life the way I want to live, how much does it truly cost me? And then that will spit out a number of how much real estate that you'll have to purchase and own in order to pay for the lifestyle that you want. So we kind of came up with this. Like I said, this has been my little driving of the ship for my own life, like figuring out what my number is, going out to dinner, going on trips, doing the things that I want to do without having to trade any more time for it. All I want to do is figure out how much property I got to buy and own, right? So that's something that we can go over, but that can kind of lead the charge for the Respark. But also on top of this, and I'll share this finally, we'll get rolling here in a second, and I was talking about this with Brent earlier, that our collective is obviously 95, 100% focused on commercial real estate, but it's also always evolving into like an opportunity club. So if anybody that's on here that has something else that they're working on or just something else that might benefit other members, please don't hesitate to share it, right? I mean, it doesn't put anybody on the hook. It doesn't obligate anybody to do anything. But if you're doing something that's working for you and it could benefit yourself and it can benefit other members, blast it on school, like blast it in our group so that way everyone can else get their eyes on it. Because we've got a couple other things that we're currently working on that we'll share on this Respark call. Just an LLH, a supplemental healthcare opportunity for business owners. It reduces payroll tax and puts more money in your pocket. The infinite banking concept, that strategy to basically remove the banking system from your life where you can earn interest and cash flow that's coming towards you versus away from you. Just a bunch of different ways that we got like, I'm introducing everybody on these calls. I've got he does a money management, but he's another guy that I just know, like, and trust for 401ks and IRAs if you guys have those. And then I've also got an estate attorney that does wills and trusts and estate planning that I would just like to introduce to everybody, just giving everybody action things and steps that they can take if they'd like to do it, right? So I just want to present as much information and people for everyone to where they can use these tools if they want to use them, right? It's just better to have more tools in the toolbox, even if you don't want to use them at a certain time. So that's what you can expect for 2026. And I'm crazy bullish. I'm crazy excited to partner with everybody. I just know that there's just a ton of opportunity, and especially with some banking relationships and some new partners that are wanting to inject cash. I'm crazy bullish on what we can accomplish. So and like I said, you'll be hearing from us over the next week or so on that Respark opportunity and these other things. So if you have anything else, though, in the meantime, text Zane and I in our group chats that we all have. And I mean, text me or call me individually if you need something. But we're just excited for what we can do together, guys. So we really appreciate it.
Awesome.
Sound good? Awesome. All right. Well, we appreciate everybody. Thanks for making it. Anything else that you have on your mind, do not hesitate to call us. We appreciate everybody. Merry Christmas to you guys. And we can't wait to see you guys next year going from there, okay?
All right, Merry Christmas, guys.
Thanks, everyone. Merry Christmas to you guys. Thank you. See ya.
Bye.